Hi everyone, I'm Karan and welcome to Karan's Gyan. Today I'll talk about exchange traded funds or ETFs. Last time I talked about mutual funds. So if you haven't visited mutual funds, please go ahead and have a look at it before you come into ETFs because ETFs is related to mutual funds. Alright, let's start. Uh, exchange traded funds are a relatively new concept in India, and a lot of investors aren't aware of ETFs and they still prefer to invest in mutual funds. So, I'd like to change your mind today. Starting with ETFs. What are ETFs? So, if you want to buy a mutual fund, you'll send a check to a fund house and say, I want to buy this mutual fund and I want to buy these many units from you. The mutual fund house would allocate you units of mutual fund according to the current NAV, which is net asset value. However, ETFs are traded on the exchange. You don't need to approach a mutual fund house to buy an ETF. You can directly approach the exchange. You can buy ETFs from an exchange at a current market price. Now, what is the difference between ETF price and mutual fund NAV? So, what happens is mutual funds are generally updated at the last minute of the stock market. That means when the stock market closes, the mutual fund calculates its assets under management and divides it by the units, as I explained to you earlier. So it'll calculate its NAV at the end of the market when the prices have settled down and the market is about to close. Then it'll update its net asset value. But the price of ETF is changing every second the market is changing. So if a market is falling and you don't want to wait for the market to close for you to get an accurate estimate on the value of mutual funds you have, you should prefer to bet on ETFs because the value of ETFs is updated on real time. All right, so I'll this form is a basic handbook for exchange traded funds taken out by NSE, National Stock Exchange of India, and it tells you what ETFs are. I would read out the form to you. You can find this form on NSE website. Yeah, so advantages. You can buy and sell it just like a share. Just like you buy or sell a share on an exchange, you can buy or sell a ETF on the exchange. Buy and sell prices are real time. I explained you the difference between NAV price and ETF price. Um, you can deliver ETFs straight to your demat account, and the minimum lot to buy ETF is just 1 unit. So what happens is when you approach a mutual fund house to buy mutual funds, mutual fund houses generally say, all right, you would have to invest a minimum of 5,000 rupees, whereas with ETF you can invest how much ever you want to invest, and with ETFs you can't buy fractional units, but with mutual funds you can buy fractional units. So this is the main difference between ETFs and mutual funds, and that's why, because of these reasons, ETFs have a greater advantage than mutual funds. So what are who uses ETFs? Anyone can use ETFs. Whoever wants an exposure in the market can buy ETFs, not just individuals, corporates and institutions. Anyone. What is the cost of ETF? Well, ETFs are have lower costs linked to them than mutual funds. Well, it's because mutual funds say that if you're buying a mutual fund, you'll have to stay invested for 1 year. Otherwise, you'll have to pay a payout charge, which is usually 1%. So they say the lock-in period for investment is 1 year. So you'll have to pay a fee for leaving the mutual fund before 1 year. So that is a problem. Whereas ETF is just like a share. You can buy it anytime and you can sell it anytime. So there are not many costs associated to ETFs. you know the only cost is the brokerage or the management fees and the taxes that are going on. There is no exit load as you put it in mutual funds. So there are a lot of ETFs. If you want exposure in indexes, like explained Nifty and Sensex, if you want to buy Nifty or Sensex, you can buy an index ETF which is meant for Nifty and which is meant for Sensex. You can, if you want to buy gold, you want to buy an index that tracks gold, you want to buy an exchange traded fund that tracks the value of gold, so you can buy a gold ETF. All right. You want to buy an index, you want to buy an instrument that tracks the value of debt bonds, so you can buy a liquid ETF. Okay, I'll explain each of you for you. Coming to equity index fund ETF. So, like I explained to you earlier, index is comprised of a lot of shares. All right. So now you want to gain an exposure to an index. What do? You'll go buy the shares which are there in an index. So according to the movement of the shares, your overall portfolio would change. All right. So you'll have to go and you'll have to see, okay, how many shares does Nifty 50 have? What are the percentage holdings of each share in Nifty 50, and buy shares accordingly, which is a tedious task. Instead, you can just go and buy equity index ETF. It is just like buying Nifty 50. It'll just track the values. So instead of building a core long-term holding of equity by systematically investing in various index funds, like you can build up a portfolio using these equity index ETFs. So if you think the market is going to go up, you can simply buy an index ETF. You don't need to pick up individual stocks. All right, no need to pick up individual stocks. If you have some stocks in your portfolio, and you want to buy index, basically you can simply sell the stocks and buy the index, as simple as that. So advantage is, index is like a share, real time NAV prices. So an index ETF would track the actual index. You don't have to buy futures for it. It's again a later concept which I'll explain you. Okay, there's low expense ratio. Like I told you, ETFs are kind of have lower fees associated to them than mutual funds. By the way, there are mutual fund houses also have their own index funds, but they are not traded on the exchange. Like I told you, you'll get the NAV of the fund at the end of the day. All right. Okay, so gold ETF. Gold ETF is, if you want to gain an exposure in gold, you can simply buy gold ETF. Gold ETF would track the value of gold. Also, when you're buying physical gold, you'll need to go to a gold dealer and say, hey, I want some gold. Gold dealer would charge you extra over that. He'll charge his making charges, his wastage charges, and he'll charge XYZ fees over it, which kind of makes it expensive. Whereas gold ETF has lesser lesser fees attached to it. you know so and gold ETFs, it is stored in a paper form or a dematerialized form, so you don't need to hold gold in a locker or hold gold with you thinking that it might get stolen, and spend extra costs of security on it. So you save a whole lot of money, and you in order to gain an exposure in gold. So gold ETF is better than buying physical gold, unless you have a very demanding wife who wants gold jewelry and is not satisfied with paper gold ETF. Anyways, either you get a better wife or you buy gold for her. Next, I told you, no wealth tax, no long term capital gains after 1 year, no storage issues or fear of theft, wholesale price for buying gold and selling, and it is listed on NSE with minimum lot size of 1. No STT. You would be wondering what is STT is. STT stands for Securities Transaction Tax. So whenever you buy or sell a security, be it land, be it gold, be it shares, be it mutual funds, there's a STT attached to it. So that's about 0.01%. Actually, it comes up to a lot if you are investing a lot of money, but still, just to keep in mind, there's no STT on any ETF, not just gold ETF, but index ETF, liquid ETF. All right, so we have liquid ETF. Now, what is the use of liquid ETF? You know, a lot of people ask me, okay, why should I buy a liquid ETF? Well, liquid ETF has a certain advantage, like a certain advantage to it, which actually helps a trader. Now, for example, you have a demat account someplace, all right, and the demat account has a trading account attached to it. Like a trading account is where you got your cash saved up. Demat account is where you got your securities saved up. Now, in order to buy or sell something, in order to buy something, you need to have cash in your trading account. But the thing about having cash in trading account is that it doesn't pay you interest. You will have, suppose you have 1 lakh rupees on your trading account, you're waiting for the right time to enter the market, but you don't know when the right time would come. It can come a day from now, a week from now, a month from now, or maybe a year from now, and you feel, all right, I'm losing a lot of money in the form of interest, you know so what should I do with that money? You can buy liquid ETFs. So liquid ETFs is to park ideal cash between two trades. So you got some money left and you want to keep your cash someplace and earn interest over it. So you can buy liquid fund ETFs. That's how it's beneficial. All right. Liquid ETFs basically puts money in debt market, government bonds, treasury bonds, money market funds, and like they deliver reasonable market returns. Like it's actually related, it's actually very close to what your savings account offer, about 6 to 7%, which is what general savings accounts offer in India. Advantages: NAV per unit is maintained as 1000 rupees. Daily returns are passed on as dividends. The dividend after dividend distribution tax is reinvested in units. So what does this mean? So what happens is, suppose you got, like 1 lakh rupees in your account. All right. So you buy, for example, with 1 lakh rupees, you'll be able to buy some 100 units. All right. You have bought 100 units. Yeah. And now you bought 100 units. You get, for example, you get a dividend of zero point 0.1 rupee, 0.1 rupee per unit you have. Like in a day, you get paid dividend every day. So you get paid zero point 0.1 rupee dividend that day. So now you have had a total of how much? You have had a total of 10 rupees passed on to you as dividend. So instead of you getting that dividend, this 10 rupees is, it is reinvested in the 100 units you've got. So now you have somewhere around, like, you basically got, excuse me, I'm actually bad with the software. So basically you'll have, like 10 rupees is reinvested, and so 10 divided by 1000 rupees, it'll amount to, like 0.01 units. So now you got 100.01 units. All right. So that's how it works. Hmm. Now, listed and traded on NSE with a minimum of lot size of 1. So what do you mean by that? I just told you that you have 100.01 units. Now, how is lot size 1 when you've got 100.01 units? Well, the logic behind it is, if you want to buy something, okay, you'll have to buy it in a unit form. You'll have to buy it in as lot size 1. But when you're holding it, you can hold it in form of decimals. When you're selling it also, so you'll have to sell it in the form of units, like whole units, like as lot size 1. So at times you might be stuck with some decimal units, but that is all right. It is better than having no interest earned than losing some amount. All right. So this is the end of the types of ETFs. Now it just basically advantages of ETFs versus mutual funds. So what we saw, real time trading and pricing of ETFs compared to mutual funds. It is real time. You can purchase ability to put limit orders. Okay, that is a little hard concept to explain, but what it means is, if you want to buy 100 units, you can base if you want to buy 100 units at, for example, 100 rupees. All right, but you're willing to pay no more than 101 rupees on each unit. So you can put a limit order. So limit order says, buy 100 units. All right, but buy 100 units as long as the price is between 100 and 101, between 100 and 101. So that is a limit order. You have put a price limit to it, that it should be within this range, and only then you can buy it. Whereas in mutual funds, you can't do that. It is the mutual fund house says this is the NAV, you want to buy at this NAV or not. You can't negotiate the price. All right. Can be purchased through a broker. Online trading, you can buy it through an exchange. You can trade it on intraday. You can buy it in the morning, sell it in the evening. You can't do it with a mutual fund. It is because mutual funds, the value of mutual fund is itself calculated at the end of the day. So you can't buy it in the morning because the value in the morning is different, and it is not possible. The mutual fund house would not process your form. They'd say wait for the NAV of the day, and only then we'll buy units for you. Okay, returns at par with the market. It tracks the index. Diversification possible. You're buying index is diversified, hence it is possible. Arbitrage between futures and cash market. What does this mean? What is arbitrage? Arbitrage is, you're taking advantage of the time value difference. Now you won't understand time value completely if you know futures, but for those who know futures, I'll tell it to you in short. Like, futures are generally as traded at a higher price than spot price. All right, so you can buy ETFs at the spot price, and technically you're holding an index. So when the index value when the future contract is coming to expiry, the futures value becomes closely related to spot. So arbitrage is eating the difference between the future value and the spot value. So you can buy an ETF and you can sell the future. All right. So if there's a 10 rupee difference between spot value and future value, by the end of the future contract, you have 10 rupees in your pocket. So that is arbitrage. Arbitrage is risk-free trades. How to invest in your ETFs? Like I told you, ETFs can be invested via exchange. So all you have to do is call your broker or log into your trading account, and you can place an order for the exchange, like for the exchange traded fund. And if your order gets matched, you will have ETFs. So these are the lists of ETFs available. You got Nifty Bees, Junior Nifty Bees, Bank Bees, PSU Bank Bees. So fund houses, there are more fund houses today. This is kind of an old old form. So then the more fund houses today. Every other fund house has an ETF. You got liquid ETFs, liquid bees, gold ETFs, gold bees. Now you can see the pricing also. 1/10 of an index. So if the index is going on at 10,000 rupees, the value is 1,000 rupees. 1/100th of an index. So there's a pricing to that index also. See, now you see how it tracks the value. It is set at a particular value to the index. So if tomorrow index goes from 10,000 to 11,000, your exchange traded fund would go from 1,000 rupees to 1,100 rupees. This is how it tracks it. Liquid ETF, gold ETF, and that's that. So guys, I hope you understood ETF. If you like my video, press the like button. If you want more videos related to the stock market, subscribe to my channel, and if you have any doubts, give me a comment. I'll reply to your comment as soon as possible. Alright guys, have a nice day.